Okay, after some technical difficulties, welcome back, everybody. Hope you guys have had a good week so far. Let's get into it. Last time we chatted a bit about our personal cash flow diagnostic and how you might look at some of your expenses, projecting them, and just really mostly the importance of knowing them in the first place. I'm sure you guys know how to do your own budget, so we don't need to go through that with a fine-tooth comb. But if you haven't done that, or it's something that you just haven't really thought about, really important for you to do. Because like I mentioned before, if you don't have a proper expectation, we can't create a proper plan. If I don't know what I'm trying to calculate for, if I don't know what I'm trying to plan for, it's kind of hard for me to create a plan for something that is an undetermined goal. So just super important to have that. With those concrete numbers, we can easily calculate needed assets, at least through some assumptions. Obviously, there's no guarantees on how returns will look in the future, but we can at least know if we're in a decent range of where we're trying to go. So this process is usually more important for midlife investors, people who still have some accumulation to go or just have time to work it out. But it's still important for those that are living on investment distributions because we can get an idea of how long we can sustain ourselves on those distributions. You'd be surprised how many people are just taking money out and think it's going to last forever. So we want to make sure we have at least some expectation of how long those distributions can last with the returns that we've been seeing on our portfolio, taking those distributions into account. Because there are some people that, well, I don't know if you've heard of Dave Ramsey, but he's a very popular financial guy on YouTube, and he has a pretty big show going on, but he touts some interesting numbers. I'm pretty for his idea of getting most people debt-free and all this kind of stuff. It's really great for a lot of normal people. But the one thing that he mentions that I just can't get on board with as an investment professional is that he thinks that you can invest in a mutual fund and safely take out 8% per year out of your portfolio safely in perpetuity forever with a growth mutual fund. And he might be right if his expected 12% annual return was 12% every single year, back to back, over and over again. But one thing that he fails to put into that idea or into that plan is something called sequence of return risk. And that's just the idea that you're not going to get 12% back to back every year. You're going to get years that are negative. And when you get a negative year, especially a strong negative year on a growth stock, you might have a minus 10%, minus 20% year, maybe even worse than that if you get into a really bad recession. And when that happens, then you also withdraw 8%. It's really hard to recover back from that. If you want to kind of get an idea of how that is in practicality, you might look at the recovery periods for different recessions previously. Like if you look at some crashes that maybe happened in a year, but took 3 to 5 to 8 years to recover that shortfall, that really puts a damper on those big withdrawal rates. So you want to make sure that you're using a rate that is relatively safe for your investments, and the lower risk you're taking on, the smaller that distribution needs to be in order for it to live longer. So that's just something to really keep in mind and understand that experienced returns or expected returns are not guaranteed, and they're not going to happen back to back every year. They're going to be up and downs, and we need to be able to have withdrawal rates that fit within that. That's why sort of 4% has been accepted as the safe withdrawal rate, because when we use that in simulations, looking backwards on all of the data that we have available, 97% plus of the time it succeeds. And it only fails in very specific scenarios where really bad crashes happen back to back. And that's just a lot less likely than not getting 12% year over year over year over year in perpetuity. So again, like I mentioned, most of you should already have a decent grasp on your budget, but knowing the specifics just makes your planning life easier. It just makes it easier to do this stuff. Yes? So it's not a percentage. What it's based on is a lifetime table. So you'll I forget exactly what it's called, but there's also the uniform lifetime table. It's essentially just whatever age you are, they give you a number to divide your account balance by, and then that gives you what your annual distribution would be. So this year, if you were 73, if you were turning 73 this year, it's 26 and a half. So you take your account balance, divide it by 26 and a half, which is your expected life expectancy, and then you divide your account balance by that, and that gives you the minimums that you're supposed to be distributing. Yeah, so it's a table that updates. Is it every year? I'm not sure. Yeah. Oh. Okay. Yeah. Right.
Then if your account had 1,200 gone up, that's a concern.
Right. Exactly. So they'll give you a table that is your life expectancy. So right. So they expect you to live by 26 and a half years or so. Yeah, something like that. It's like pushing you close to 100 years. No, not necessarily.
Not planning for.
Yeah. Yeah.
It's full out more. Well.
Yeah.
That's.
Yep.
Well, I was wondering.
Sure. Uniform lifetime table, I think is what it is. There's one of them. Yes, there's a few. Yeah, but if you just look up RMD table, you'll find it. You'll find it there. I think Fidelity is where I pulled that information from. They have a page on that.
Yeah, we guess about 4% or so.
Yeah.
Slightly, but it is an aggressive, and you're not going to run out of money at 90. They don't know. They may control all that.
Yeah, especially if you're invested and you're collecting dividends or have any kind of growth, it's not going to drain you down pretty much ever.
And Nash has programs of how to allocate it later. They'll talk about which money has to come out early, mid, and later.
Yeah. Okay, and then insurance. We talked a little bit about how we should be looking at insurance. You know, at this stage of life, there's probably not that much planning to be doing, but really it's just looking to make sure you don't have vulnerabilities. We don't want assets to be vulnerable. Things like long-term care can be pretty important if that's a coverage that is affordable, because as we've talked about before, expenses can get really high for that sort of thing. I mean, we've seen personally in our office, we've seen expenses of $20,000, $30,000 a month, every month. And if you've only got a couple $100,000, that goes really fast. So coverages are really important to have. Umbrella is another important one we talk about a lot because some of your liability policies might not catch all of your assets. So it's important to get all of those covered if there are vulnerable assets so that in the event of a lawsuit, you're not completely out of luck. So a plan will have a great reduction in probability of success if assets are depleted from an unexpected expense. Now, the way that we look at that probability is pretty much looking at the income needs that need to come out of portfolios and the distributions from those portfolios, and sort of looking at that same simulation when we're talking about a safe withdrawal rate. It's sort of a similar calculation. So we're looking at a lot of different scenarios and seeing how much can we expect this to work out. Because if your assets are reduced and your distributions need to go higher, there's still a chance that it could work. It's just lower because you don't have as much breathing room in between. So it's really important that we protect our assets to keep our plan at a high chance of success. Okay, so basically, we'll just paint a little bit of a scenario. Let's say you've got all your different liability insurances, say car insurance, for example. Say you get into a really bad car accident and you get sued for $2 million. Let's just say that's the number. And your car insurance hits up to about 500. So your car insurance will pay out that 500 for liability, but now you're stuck with the $1.5 million. So where's that going to come from? Well, it's going to come from money you've got. So if you see, let's see, say like an individual brokerage account or any other assets that are within reach that aren't considered protected retirement assets, all of those are up for grabs. So if you don't pay the bill, they'll just take that. Versus if you have an umbrella liability policy up to that $2 million, then you might say, okay, so the auto liability covered 5 of that. Now we've got $1.5 million left. Luckily for you, the umbrella steps in and covers that leftover $1.5 million and pays that out to the suit, not touching any of your assets, leaving everything that you have alone so that all your assets stay at the same amount and you can continue your distributions as planned. Yes. So that will be things like plans that are covered under ERISA, a qualified plan like a 401k or any of those qualified plans. Those will be protected. And remember that if you roll those over into an IRA, make sure they stay in a separate IRA by themselves. Don't ever combine an existing 401k into an existing IRA. Otherwise, you will lose that protection from creditors and lawsuits. Just keep that in mind. If you're going to roll over a qualified plan, roll it over into its own IRA or an IRA that has only received assets from other qualified plans. Otherwise, you'll lose that state protection. Yeah.
So if you have a 401k or anything that's designed as your primary retirement plan, and that protects even if you roll it to a rollover IRA. If you combine it to an old IRA, they won't protect it automatically. You have to hire a bunch of attorneys and CPAs to argue it separately, but it's better never to do. So you are protected.
Yeah.
This is protected $650,000.
And also to mention, there are some protections that you get with a regular IRA. It's not to say that there's zero, but the case has to be argued. And that's kind of the point, is if we have to get into a situation where now we have to argue for why it's protected, it's safer for it to be somewhere assumed protected. So if we're covered by ERISA or California's version of that that extends the coverage, which is what you get when you roll it over to its own IRA, that will assume that it's completely covered and there is no question. Versus if you have it a separate IRA that you've contributed to or that you've commingled assets from different plans in, there are limits to the protection. It might be a million something, but it's also percentages, and it has to be argued how much of that is going to be for your retirement that reasonably pays your expenses. And then it just gets into this whole fuss of how much of that is protected and how much of that can we argue needs to be protected. I would prefer not to have to argue and for it to be assumed that it's all covered. So that's why we keep those ERISA plans separate in their own IRAs. So we talked about all the different types of insurance that we might be looking at, different things to look at, and remember to basically look over and make sure that you're getting your max coverages where it's feasible. And if you end up going for an umbrella liability policy, that will usually make you max out your coverages on other policies. So if you end up shopping for that, by default, they'll usually make sure that your auto and your home liability get pushed all the way to the top so that they're not on the hook for as much. Because like we mentioned, an umbrella policy for $2 million is not really an umbrella policy for $2 million. It's an umbrella policy for $2 million minus whatever has already been covered by other liability policies. So it's really kind of, you want the umbrella to be the totality of your assets. Even if your assets are covered by something else, you still want that umbrella to cover everything in its entirety. Oh, yes.
No. So is insurance really worth it? I mean, there's always this little tiny, unvisible, tiny, my friend. They'll always find ways not to pay you, because that's my first experience.
Sure.
Like, I'm so against insurance.
Right. Sure. But I'll pose you a situation. If you get sued for $1 million and you don't have any liability coverage, you will have 100% responsibility for paying that, and your assets will go. Sure.
There's some people that believe that, I'll take them coming after me, get the attorneys, and I'll just give up the way that's possible. And the insurance company's job is not to cover. Their job is to fight. He had one client, I had one client in the 80s. He had 50,000 liability, so I got him to raise that up to 300,000, but uninsured, underinsured also. And so he got hit by a car, and the bad guy gave him 15,000, and that was it. But then he went to his own company, of which he had to sue them to get the other 285. So they absolutely don't trust insurance. And that's why we want to get all the protections you can. Then if you want and need insurance, the best thing that you can ever hope for from insurance was that it was the worst investment you could do. So you could try.
Yeah.
Can they take over your house if you don't have $2 million?
Yeah, so it kind of, there is some homesteading protection that you get, which, what was the number for that? Yeah, 650,000. So as long as your equity sort of stays within that, that's the other thing, is debt can help offset that. Because if they can't get any money out of it, they're going to have to pay a mortgage with the value of the home anyway. There's no point in taking that asset. So there are some clever things that you can do here and there, but just, that might be a reason why you might be maintaining a low interest mortgage or making sure that your value stays within that homesteading protection. Other different things, they're just kind of keeping that value within that. But if you've got a really expensive home, you've got $1 million, $2 million home, and obviously it doesn't get covered by that, very helpful to have that protection.
You don't need it. You have a house, 650,000 or less, and you have ERISA protected retirement plan. And not much else, then yeah, you don't really need, but you don't want to buy it this way. But if you do have things that exceed those amounts that Ange said, that's what
Yeah. Yeah, that won't be protected. Yeah. So then we also talked about some basic estate planning things. Really just a lot of this is just directional, making sure that things go in the right way and nothing gets stopped. We want to make sure that everything flows like an unblocked river. We want it to make it to where it's going to go and not get trapped up along the way and get caught in court process or get caught by fighting beneficiaries or any of those things that we're not able to deal with after we're gone. We want to make sure that everything goes as smoothly as possible after we're gone. Because while we're here, we understand that not everything has to be perfect because I can be there to fix it. But when you're not there to fix it, you either have to make sure that somebody is there to make it go the right way, or to make sure that you have already set everything up in advance so that nothing really has to be touched too much and it all just flows to the places you want it to go. The durable power of attorneys will be very helpful in situations like that when you're kind of in that in-between period. If you get incapacitated and something needs to keep happening in order for everything to move quickly, making sure you have the proper beneficiary designations so that policies go straight to where they need to go, retirement accounts go straight to where they need to go, bank accounts become available for people to deal with. All of that is very important so that assets become within the control of people who need to be in control of them so that your directives can be followed. Okay, yeah, you first.
For what it's worth, what I
Sure.
understand is it's really a smart thing to have the same people as the power of attorney that are also your successor trustee or your executive. Like if you have different people for when you're alive versus when you die, that is really messy.
Yeah, it can be depending on your planning. There are some situations where you can have things a little bit more segmented, especially if you know that certain people are going to be good in certain areas. Like obviously there are going to be people who can make better emotional decisions, but don't make as good of financial decisions. So you might think, I want this person in charge of my medical care, but I don't really want them to be messing with my finances.
Finance.
Right.
Executive.
Yeah, and that's very, very common. Yeah, exactly. Yeah. Right.
I don't know if we can get into this, but, for updates. to the-
Yes.
Does it have to be done by a lawyer, or can I just put a little yellow sticky note? And it's just- Some people say you can write a letter to the trustee and notarize it and say, dear trustee, and then say what you want. Attorneys will argue that that would be the letter. If you have other beneficiaries that might fight with each other, but if you just have basic one or two beneficiaries, I've heard that you could write a letter, notarize it, leave it to the trustee and say that you've made some changes. But you can go back to an attorney and have them update the trust. I forgot what it was called, if you remember. But they usually want to charge it the same, right? So, but the main thing is keep the name. If you change the trust name, you gotta go back and re-register. Right, but if you do the trust update, anybody can remember.
Amended and restated.
No, there's a name. If I think of it all.
I have a question based on trust. I've seen some new things that bring, one of them is called Get Dynasty.
Oh,
Have you heard that stuff?
no, but I watch a lot of attorneys, and you want to be very careful that whatever trust they're saying does something spectacular, you better make sure they.
Well,
know what they're
it says it's just not as expensive. We can achieve it
Oh, okay.
anytime without.
And obviously you can do some trust online. You don't have to have an attorney if it's not. Restatement is what I was looking for. If you have a trust and you don't want to change the title, you can restate it, but they always find a reason to charge you more. If you have a simple, give my assets to this person, and it's not difficult, watch some YouTube videos. I encourage people to do that all the time. Why pay $3,000 to $5,000? Unless you've got a Hollywood script that you want to put in the trust, then you need an attorney to do that. But they have all kinds of programs you can do.
Mine has a page and it's called minutes. You can put in there and change it.
Okay.
Are they binding?
I have to ask the attorney, but my guess might be their suggestions to the trustee. So if that person recognizes your handwriting, you get a notice, I'm gonna guess, but I don't know at that point. In our situation, Nash is my durable power of attorney for financial. And it's not that he's not smart enough, but if my things fall into an irrevocable trust, and he's also the trustee, wouldn't you call that a conflict of interest? Right? So he doesn't want that conflict of interest. He'll be the trust protector. He'll be telling people, you don't do what the trust says, we're gonna fire you, but we don't want him to lose his legal protection.
Exactly. And when it comes down to those things where you might just be writing letters or doing small little things to adjust the trust, one thing to keep in mind is those things might work if nobody challenges. That's a really important thing to remember is if there's any chance that a beneficiary might challenge what is coming out of the trust, and there's not clear documentation of that adjustment being written into the trust, it could be fought by an attorney and potentially just completely discredited. And then they'll have to go back and pay other fees and make the assets go where they need to go.
My issue with this is that over the years I've bought and sold a few different properties that rental properties. Okay, so every time something occurs, you gotta go back to the trust people, and include it or exclude it depending on your situation.
Right.
They have restated it in the term
Yeah.
used a few times, but after a while, I think the restatement, what do you call it, don't you sometimes, I'm thinking now, maybe I just give it a whole damn thing and start from ground zero. And start with completely new trust, because restate or restate.
Yeah.
Yeah, I can do it.
Because you're also saying that the restatement's gonna cost about the same amount.
Right, the only problem is if you do a new trust, do you have to come up with a new name? The only way you can keep the same name, if you have other assets entitled in that name, is to restate it.
Okay, so what one can do is restate, let's say, all prior trusts are void.
Yeah, whatever
void-
I would have an attorney do that.
Right,
Yeah.
trust attorney do
It
it.
seems like you can do that. You're gonna restate just to keep the old title, so you don't have to change all the registration.
If I could register, where you register?
Restatement.
No, you said, it, so you don't have.
Oh, you might have a trust, a brokerage account, you might have other, bank accounts and all that other stuff in the name of your trust.
I didn't have one trust for everything.
Right, but if you go do a new trust, you can't keep the old same trust name unless you do a restatement. Right? So that's why a restatement keeps you from having to retitle it. And at that point, I would pay an attorney, but if it's not necessary, you could go on the market.
But you said you, it was something about registration.
Right, if you,
Where is it registered at?
well,
What do you mean by registration?
well, I have my trust, Hunter William Bailey, Living Trust dated such and such.
Right.
When I go set up a brokerage account, it's in the name of the trust. So
Oh,
if I
yeah,
do,
that's what you mean by
yeah,
registration.
yeah, it's,
You put it in the trust.
so the trust is like a car manual in the glove compartment, but the car needs to be licensed to that manual. Or if you adopt a child, my sister was my cousin, so she was adopted, my parents changed her name to Alan, right? So if you do anything and it's, you have all these property, I would definitely talk to an attorney and I would have insurance on this property.
Now, here's an idea for some restructuring there. Tell me if this would be helpful or not, but would it not be beneficial to take all of these separate properties and put them into a corporate structure that's owned by the trust so that you don't need to change details every time within the trust? As long as it owns that corporate entity, it also owns all assets that are owned by that.
Right. They're minor little inherited stepped up bases that could be affected by.
Right.
I have several properties owned by one LLC. Normally you have all owned separately because you don't want it to affect each other. But all of these properties in this LLC, the LLC's shares are owned by my private trust. California, similar to ERISA, but it's not tax deductible. I don't get deductions. I pay taxes on everything. I put the properties in there. Then if you sue me, then we say this is a private retirement trust. It's for my retirement. You can't take the asset.
Yeah, so that might be a bit of an idea, is if you can group these assets together into something that, so that every time, the trust can just own that corporate structure, an LLC like that owns everything that is owned within that. So you don't have to restate it every time that there's a change within the assets owned by that corporate entity. Yes.
Okay, trust. I want to follow up on the question I asked last week about a living trust, but the trustees were actually the people who the trust was for. I mean, obviously they have stated beneficiaries within the instructions of the trust if one was to die. The way that it was set up is that if when one person dies, that living trust, if irrevocable living trust. But I go back to Nash's point last week, which was, well, when you're having a trust or in this case, a living trust, and the trustees are the people themselves, then it seems like there would be a conflict of interest. So then how do Romney and Associates, for example, write such a trust where the trustees are not other?
It's always nice to have an outside person not be a beneficiary, and you can hire a private beneficiary. There are conflicts, but, and the other thing is, you usually don't like to see two trustees, right? You like to see one.
Yeah, having multiple trustees can be kind of rough.
Some companies. If you have multiple trustees, because they don't want to get in the middle of a family fight, right?
Yeah,
So but we've seen both two trustees, and they're also the beneficiaries, brother, sister type thing, hopefully they get along. It
Yeah.
could be a logistical in a family type thing.
this was like the spouse, like the husband and the wife were the trustees of their own
Okay,
living trust.
that usually happens because if one dies, then you just take the decedent off there, and then the surviving spouse can do whatever they want. And it's a revocable trust, so they can change it.
Oh, yeah.
So
Well,
you,
yeah,
you,
they made it, they wrote it that it was when one dies, that's irrevocable.
okay, so they can't go get a new mate, give them half the money and all that.
Interesting.
But it is not have the wife be the trustees of their own.
Oh, we see, it. That's almost all, right?
Oh,
Yeah.
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 But it's a revocable trust in both
Oh.
cases. If the one dies, the survivor can get a new mate, give them half of their, but if it's an irrevocable, that.
So again, all just the simple stuff, wills are usually for those very small estates, only maybe 150, 160, I forget how far up it goes, but small estate affidavits that you can do, really good for capturing that personal property, things that you might not want to all name specifically. If you got a bunch of card collections or something like that, I don't know. Trusts, really good for those larger estates or specific instructions or just organizational purposes and stuff like that, where you can bring it all into one bucket and have it distributed in the proper ways. Beneficiary designation is really important. Very quick, very snappy transfer straight to the person that it needs to go to. As long as you make sure that that doesn't conflict with trust instructions, like we heard, make sure that everything agrees with each other with where it's going to go. That's very important. Durable power of attorneys, like we mentioned, super important that you have somebody you can trust to take over in the case that you're still around, but you're not able to make decisions for yourself. Then we talked about tax diagnostic. Again, not much that we're going to be able to do to completely erase your tax liability, but there are a couple things we can do to make it a little more efficient. Looking at some tax advantaged investments, tax credit investments, things where you might get a tax credit for putting your money in there. Mutual funds versus ETFs and the accounts that you use them in, and tax-deferred annuities, tax-deferred investment vehicles where you get your deductions, Roth accounts where you get your earnings and your principal tax-free at the end of the term, all those sorts of things where you can just make things a little bit more efficient. Maybe there's a little bit of math that can work for you. And just remembering that those Roth accounts, they really just lend themselves to people who've got time for assets to grow within the Roth, because unless you're trying to pay the taxes for beneficiaries early and let them get the assets so they can grow tax-free, when you don't have too much time, if you've got maybe, I don't know, less than 5 years or less than 7 years, it's hard for the math to really start playing out unless you think tax rates are just going to start flying and this is your chance to capitalize on whatever bracket you're in right now. So today we're going to start very gently getting into our investment things, which will be kind of the bulk of the information and the teachings and all the complex stuff that you'll learn. So we're just going to start talking about some different account types, different funds, market indices that we use to benchmark things, portfolio diagnostics, and ETFs and mutual funds. And we'll start getting into that so you can start learning about how to actually craft your investment portfolios for your needs. So when we're talking about account types, we got two big broad stroke accounts that we can think of. We've got qualified accounts that receive tax advantages, which could be pre-tax savings. So you're deferring your income taxes by putting the money in there, not paying income taxes on it now, but accepting income taxes later. And then we've got non-qualified accounts, which are all other account types in which contributions are made with after-tax dollars and earnings are taxed for the year in which they are received or deferred until withdrawn. So a Roth account is not technically a qualified account in that way, but it does still receive some benefits, obviously. So in our qualified accounts, yes. I would say deferred comp, yes, okay.
Some though are called state plan.
Right.
An actual deferred compensation plan is deferred compensation, so you don't pay taxes on it until you roll it and pull it out and do something. But there are savings plus plans that you put money, you do your deferred comp, they say, hey, you can put in some more money. The non-deductible dollars go in and they grow tax deferred. And then when you pull them out, the original money that wasn't deductible isn't taxed the second time, but the earnings can be rolled over to them.
Okay, so talking about our qualified accounts, we'll have things like company retirement plans, 401ks, 403bs, 457bs, profit sharing plans, employee stock ownership plans, all your IRAs, traditional, rollover, simple, SEPs, and qualified tuition plans like 529s. With our non-qualified, we'll have our individual accounts, joint accounts, community property ownership. So these are just your basic taxable brokerage or bank accounts, things like that. Trust and estate accounts. So obviously trust accounts are not qualified. They're going to pay taxes, and it is a lot faster that they reach that 37% bracket. It's not necessarily that there are higher rates, but you just get to that high rate a lot faster because the income level is a lot lower. So something to pay attention for. Custodial accounts like UGMAs and UTMAs, so that'd be unified gift to minors accounts and unified transfer to minors accounts. Those are also not qualified. Business and entity accounts, obviously those are paying income taxes in their years. And Roth IRAs, because the contributions are after tax and you're not deferring those taxes, but you're deferring taxes on the earnings, they're still considered not qualified. So now we'll start talking about a couple popular investment vehicles. I'm sure everybody knows what a stock is. A little piece of a company. You own a little tiny slice, depending on how many amounts of outstanding shares there are. You own a little fraction of that, and you might be entitled to a share of their earnings, which is their dividends. You can look at different things like the dividend payout ratio or the earnings per share. So if you see earnings per share, that'll be how much of their earnings that they have for the year are attributable to each share that they have outstanding. And their dividend payout ratio will be how much of those earnings are they paying out to their shareholders. Some it might be really small, some it might be a lot. Usually those ratios are lower on growing companies, younger companies that are reinvesting those earnings back into their company to grow, versus the higher percentages usually are coming from more mature companies, bigger blue chip stocks that have been around for a while, that have a large, what we call a moat, sort of a protection in their industry where they're very well established, and it's not likely that a competitor can just come up and steal their market share. So those companies will generally pay out higher rates of dividends. Bonds are similar to stocks in a way in which you're owning something, but you're really owning a debt. So you are pretty much lending money to whoever is selling you this bond, because you are lending them that amount of money, and they're going to provide you interest as compensation for lending them that money. Just like if you were a bank or something like that, you're going to get the interest as compensation, and then at the end of the term, you'll get your principal back to repay. And that's maturity, is when that happens, is when you get your principal back. There's also original issue discount bonds or zero coupon bonds, which don't pay you interest, but you will basically buy them at a discount. So you'll pay less than the principal you'll receive at the end, and you have to what's called impute the phantom interest. So you kind of pretend, if I give you $1,000, but you're going to give me $1,100 at the end of the term, we have to stretch that extra $100 over the whole term of the ownership of that bond and pay the little fractions as we go year over year, because that's our phantom interest that we would be receiving on a normal bond. Now, this is usually happening on something like a T-bill, on a very short-term treasury investment. Usually we'll buy those at a discount and we'll get back a little bit extra at the end of the term. This also happens with strip bonds, which are basically when I don't know who does it, but some company will take a bond and they'll break it into pieces. So then you'll have just the interest piece and just the principal piece. And then the principal piece gets sold at a discount, and then they'll return back more of that money at the end. And the interest, usually they'll keep, and they'll just keep getting that interest over the time until the original bond matures. Commercial paper is also like this. That's like kind of like a T-bill, where it's a very short maturity, but it's from a corporate entity versus the government. Yes.
Getting savings.
Right.
That T-bill?
So they're kind of similar, but they're different. They're a little different in their tax treatment, and some of them, they're kind of similar to that, but they can be different terms and just slightly different. Yeah.
We all remember what would happen is you'd get a bond certificate, and you would have another part of all these little tiny coupons, right? Miniature ones. Tear them off and get dates on to go to the bank, and the bank can give you the interest, representing the interest on the bond. And then we watch Hollywood movies where the guys break into the vault and they get all these bonds, right? And those are coupon bonds that if they have the physical certificate in their hands and the miniature little coupons that were replicas of the bond, then they can get all that interest. Now, it doesn't work that way, but that's why we always say, put your coupons type thing.
Yeah. So next up, we'll have what we will use almost exclusively in all of our investment portfolios. This is all that we use in order to craft our portfolios, and we're leaning more towards exchange traded funds now. But mutual funds and exchange traded funds are two sides of the same coin, really. The whole point is that you are offloading some management duties, some of the work of putting stocks and bonds together to a fund manager who's going to pick them for you. Now, this could be actively managed. They could be choosing them in and out and moving in and out of positions, or it could be unmanaged. They could just be following a list that somebody else has published somewhere. But the whole idea is that you put all of these different stocks and maybe bonds all together into one product that you can buy and sell easily. You don't have to worry about buying and selling bonds on the open market, buying and selling stocks on the open market, and trying to get the best prices for all of those individually. You'll just have them all in this one packaged little product. They could be stocks, could be bonds, they can even be derivatives or alternative investments. So this could be a way, if you're interested in an investment type that you don't really have access to, there might be a big mutual fund or ETF where they use all their millions and billions of dollars to gain access to it, and then provide you with a little fractional share to have access to that in your portfolio without having liquidity risk, for example. You might have something like say, for example, you're really interested in Bitcoin, but you don't really know how to work a crypto wallet. You have no idea how any of that works, but you just want some exposure to the asset. Usually you'll find ETFs that work kind of like a gold trust. Same thing as if a commodity ETF, where they'll just hold a bunch of Bitcoin in their trust, and then they'll let you buy a share of their company that's holding on to that. Now, previously, those have been very expensive for whatever reason. I remember seeing Bitcoin ETFs at like a percent and a half management fee, and all you're doing is holding Bitcoin. Like, it's not even an actively traded fund. Nowadays, though, there's more options popping up for that. Yes.
I don't want to get you off the subject, but can you give me a short definition and of Bitcoin? What's a Bitcoin? I don't know the Bitcoin market. I've never.
Yeah. So cryptocurrency, we'll give just a very brief synopsis. Sorry? So basically, what ended up happening was there was a desire for what's called a decentralized currency. When we think of currency normally, the US dollar, for example, it's really controlled by one central entity, and that's the Federal Reserve. They have to be able to create more of that. They have real control over that. The interest rates that are all of this, it's all controlled by one central entity. So theoretically, if that one's...
There's anything too. Okay, you have a central bank that control all this.
Mhm.
And then on the international market, you also have the dollar be the dominant.
Right.
It's the medium of exchange international.
Sure.
Because then I also hear that the Chinese and some of these other non-Western countries are trying to establish a non-US dominated world economy. So what a bit, I don't understand. I understand that to an extent that I can understand the United States side.
Yeah.
But then what are the big?
So Bitcoin was really it was a proof of concept. So early on, that was one of the, I believe it was the first cryptocurrency to actually be popularized. And the way that it works is essentially you're taking that job of centralization where you have that one center controlling it, and you're spreading it across the entire community that participates in it. So that's where, everybody that participates in it, there are two sides to this. You'll have a consumer who might own some of the currency and distribute it back and forth, and they're able to send it back and forth electronically very quickly and very cheaply. But on the other side of that, you had miners. So you'd have people that gave their computer hardware up to this system so that it could process those transactions. So instead of having one central group that processes all of that, instead of having one central organization that determines whether everything is accurate, what the value of things are, that is spread across anybody who wants to participate. So somebody would put their hardware up to do the calculations to make sure that all these transactions happen properly, happen securely, happen correctly, and they would get rewarded with little pieces of that currency for them to hold. And really, it was just to make that, really to make sure that there wasn't anybody in control, that there wasn't anybody who could flip a switch and say, your money is mine now. Getting back to our conversations, Bitcoin would be considered an alternative at this point. Well, some of the cryptocurrencies are considered commodities. Some of them are considered unregistered securities. But point being, mutual funds and exchange traded funds can allow you exposure to a lot of different assets, some that you might not be privy to, and some that you just want to have contained in the same area. Fixed annuities are another type of investment. We don't usually like to consider them investments, but you'll see them in a lot of investment plans. You'll see a lot of insurance agents selling them as investments, especially when we get to variable annuities. But a fixed annuity is essentially an insurance contract where the issuer promises to pay a stated interest rate on contributions to the account over a specific period of time. Usually those periods of time are either life or period certain, or a combination of the two. You might have a policy that pays over the life, then once the life ends, it might continue for a certain period if the life has ended within that period certain. So if you have a 10-year period certain and you live for 5 of those years and then you die, it's still guaranteed to pay out for the next 5 years to whatever beneficiary or whatever you've got named. But fixed annuity is really just that basic. You either put a lump sum in or contribute up until what's called annuitization, where it takes the account balance in there and then starts paying them over the lifetime. So even if their investments don't do as well, they're still contractually obligated to continue paying you those equal payments. Usually, they'll bake all of those risks in, so you're not going to get what you would have if you had invested yourself. You probably would make more. But some people really like those guarantees, even if they know they're giving up some growth, if they're giving up some of those bits of income. There's nothing necessarily wrong with an annuity if you know that it's the right product for you and you're accepting what you're losing. But a lot of the times they get marketed as something that's better than what you can do on your own. And that's when I start to have a problem, because when we get to something like an indexed annuity, this is where things start to get a little more complicated. They're similar to fixed annuities, except that the interest that's credited to your account varies based on the performance of an investment index. Now, this will be marketed as a really good thing, because usually they'll say you can't ever get negative interest. We're not going to take money away from you. But if the index performs 10%, we might give you 7%. And that's pretty good. We get to pocket the 3, you take the 7. It's all great. And that's okay. You do get some of that money in your account. But like I just mentioned, interest rates are usually limited by caps set by the insurance company. So the one that I kind of just mentioned, if they make 7 or they make 10 and you get 7, that's a cap or a participation rate. If they stop you at 7 and say you can't earn any more than 7, that's your rate cap. But they might also have a participation rate that also bakes into that to say you only get 70% of what the return is. So let's just say, for example, if you've got a participation rate of 70% and a rate cap of maybe 5%, if the index returns 10, and you say, oh, great, so I'm going to get 7% of that, right? Except for the rate cap cuts you off at 5. So you don't get to get any more of that. And then when it does poorly, you get nothing. And when you look at those returns over time, generally they just don't even stack up anywhere close. Even to fixed annuities, they can be pretty abysmal, or to like treasury bills right now, where you can get a free 5% on your money year over year pretty continuously until the rates start to fall, as they might have already. Now, non-publicly traded investments are things that we really don't like dealing with outside of mutual funds and ETFs that hold them for us. Things like limited partnerships and non-public real estate investment trusts. And the reason that we're not a fan of these, not necessarily that all of them are bad, but it's because of liquidity problems and lack of transparency. If we can't see what's going on inside them and it's difficult for us to evaluate it, there's really no point in keeping it in our investment plan. If you are the expert, if you're the real estate guy, you might see a non-public real estate investment trust or some sort of limited partnership that does exactly what you want to be doing, but you just don't have the time or the assets or whatever it is. And if you're the expert, that might be the thing for you. But if you're not, if you're just another person trying to make your investment profile last as long as you will, these things can be kind of risky, because again, liquidity can be a problem. We see problems like this with some REITs where a client will come in and they'll say, I've got this sitting around and I don't really know what it's worth, because their statements hardly show them any information. And then I'm looking around and I'm looking, but then we also have to consider how long has it been? Are they actually able to withdraw all of the assets from these different investments? And we just get to a point where usually it ends up that they've just been losing money year over year over year over year, and they didn't even really know. And now their $20,000 investment might only be worth 4 or 5. And even then, it's difficult for us to redeem. Just, you run into problems that you just don't need to have. So we like to keep things simple. We like to keep things easy and liquid so that we can move in and out of them whenever we need to. So internally, these assets, mutual funds and ETFs, will use a variety of assets to make a particular portfolio for their customers. Like I mentioned before, you could have a Bitcoin ETF, and their job is to put Bitcoin in there. You might have an asset allocation ETF, where their job is to put you at a 60-40 portfolio within this one fund, or something else like that. You might have a growth fund that's just supposed to buy growth stocks, either according to an index or according to their own research. There's a lot of different things that they can do to create a portfolio or create a list of internal assets that you might want exposure to. So we'll look at a bunch of those different assets right now. We talked about a couple of them, but you'll have your cash and cash equivalents, basically anything that can be converted to cash really quickly, and you're not worried about loss. So those will be things like bank savings, certificates of deposits from different banks, US government treasury bills, like we mentioned, those 52-week or less. Basically anything that matures in a year or less can be considered a cash or cash equivalent, because for the most part, those have the least volatility. So this will also include things like corporate commercial paper and any other money market instruments that you might have. Bonds, like we mentioned, fixed income instrument that represents a loan made by an investor to a borrower, usually corporate or government. So you have all these different types of bonds, and you can have an ETF that might be towards high yield bonds or junk bonds that's just looking for lower credit quality but higher yields. You might have an ETF that just does treasury bills, and they just rotate them in and out so you don't have to buy them every time. Because when it comes to treasury bills, you can get very, very similar rates to the actual individual treasury bills with an ETF. You might lose 10, 20 basis points, but you can let them do all the work of renewing them over and over again for you and making sure that your money is more liquid. Yes?
US Treasury bonds taxable
So they are federally taxable, but not state, right?
individually.
Yeah.
You know, I don't think
No, it passes. I'm pretty sure it passes through.
it does.
Yeah. Yeah, because otherwise, I mean, why would you?
I mean, you would think if you don't manage mutual funds, they didn't let them get it because
Right. Yeah.
Confirm that. But if you have an ETF that has treasuries in it, confirm that it's tax state. But we remember what ETFs. Yeah, it's a mutual fund you can buy and sell like a stock.
Okay. So then you'll also have, mutual funds and ETFs with stocks in them. As we mentioned before, you'll have your US equities and your foreign developed and emerging markets. So US equities are usually the majority of what we use for our stock positions, because it's basically the most developed economy, and it's, relatively more predictable than other countries. And there's just a lot to choose from because of how big the stock exchanges are. With foreign, you've got your two sections, developed and emerging. Developed is really just a country who's, pretty well set. They've got high living standards and stuff like that. And emerging is our way of saying that it's got a lot of ways to go. They're kind of lower on the scale, and there's a lot of growth that can happen. Higher risk, but could potentially be a lot of payoff in the end. But it's hard to, there's a lot of different factors that come against that. It's not just a company trying to be profitable. It's also a country trying to develop further, a lot of political risk and stuff like that. So we usually like to use foreign assets just to give us a little bit of different return compared to our US equities. So if I have US equities that have a certain amount of volatility and they're going up and down, I might throw in a little bit of foreign so that on some periods where the US equities go down, foreign markets might do better or actually good. So we'll just give us a slightly different direction of return so that our assets don't all drop at the same time.
Lower price ratio.
Yeah.
They're not, they don't perform well. It's US is the place to be. But if you want to get the lower price for a relative dividend, the lower price, they tend to be a little bit cheaper.
So alternatives, we can talk about a couple different versions of alternatives. Usually, these are just things that don't fall into the conventional categories, conventional like stocks, bonds, cash, all that kind of stuff. So we've got real estate. You'll find that in real estate investment trusts. We've got commodities like precious metals and now some cryptocurrencies, things like wheat and oranges and all sorts of different things that can be traded. Hedge funds. You can actually find that hedge funds are alternative assets, and because a normal investor can't get access to them without having oodles of money and being an accredited investor and stuff like that, that's why it's considered an alternative, because you can't just buy and sell it on the open market. You actually have to sort of be invited to participate. Yeah.
Private placement fund, is that a hedge fund?
Do you remember what a private placement fund is?
It's more of a limited partnership, and for smaller groups of people, they don't have because the limited partnerships, if it's to a public person, you're a limited partner, and you're only at risk of losing your money. But if you want your general partnership, private placement, you're almost like a general partner. The tax thing don't work out, and it's not that happens. So there's a saying about limited partnerships, especially general partnerships. Going into it, the limited partner has all the money, and the general partner has all the experience. Okay? Coming out of it, the general partner has all the money, and the limited partner has all the experience. So if you do anything like that, it's restrictive and it's hard to get in and out of, and you don't know what's going on. So we would recommend publicly traded assets. However, a successful general partnership or private placement could be great because the colleges, all the private investment money goes into those. But for the average person, we'd rather see transparency and liquidity and give up some of that high risk.
Okay, so another thing that we can have is derivatives, things like futures and options contracts. While you can trade those by yourself, they are still considered alternatives. And you can find funds that can generate some extra income through derivatives or other things like that. Managed futures. So futures are a derivative because they derive their value from a different asset. You might have the S&P 500, but you can also trade futures contracts, which are basically betting on the value of that at some period in the future. And you'll have funds that attempt to either beat or give you similar returns to indices with futures. And usually they're trying to hedge against downside risk and other complicated things that we can talk about more later. And then things like art and antiques, which I probably wouldn't put in your retirement portfolios, but it's an interesting thing to look at if you're at all interested. So now we'll talk a little bit about market indices. So what is a market index? It's pretty much, it's a way to categorize a part of the market or to really just put a lot of securities into a list so that we can track them as one entity. And they're used by investors and fund managers as a tool to evaluate the performance of a stock market. So usually we'll use an index to say this is representative of this market. So in the US stock market, we like to say that the S&P 500 is a very good representation of the market. And you can see this where if you go look up any total market fund and an S&P 500 fund and you put them side by side, they will have almost exactly the same performance because those 500 companies, or whatever silly close number it is now, drive 99% of those returns because of their size and how it's all tracked. So a market index fund tracks the performance of a specific grouping of stocks considered to represent a market or sector of the US market or economies, or foreign markets as well. So you'll have the major three that are talked about the most frequently. Number one is the Standard & Poor's 500. Yes?
I looked it up. People were right. That's wrong. ETF does pass through interest to federal taxable, but not state taxable.
Yeah, this is why you can still get municipal bond ETFs and things like that because the tax treatment passes on to you. Yeah, so you've got your major three stock market indices. Number one is the Standard & Poor's 500. You'll hear that one talked about every day if you're looking at anything economy related. So that's a market capitalization weighted index of 500 leading publicly traded companies in the US. So this is, it's not weighted equally, so it's not a same amount of capital for each index, but it is, they are market capitalization weighted. So the bigger companies that have more market share, there will be a bigger representation of those in the portfolio to reflect how they actually exist in the market. And then the second one is the Dow Jones Industrial Average. This is one that you'll remember for a long time has been around, and it tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange and the NASDAQ. You have any input on the origins of that?
Mr. Jones, what was it? Oh, yes, it's here, Mr. Dow and Mr. Jones back in the railroad days, they got together and then they expanded.
Okay. Give me just a second here.
And that's why they say cash on the barrel. They would have barrels out there.
Yeah.
Right? Traded the stocks. And there was a lot of scams going on there. They traded the stocks for cash on top of the barrel. That was the desk. Or they actually had the New York Stock Exchange, right? They were just out there as a bunch of people trading.
Yeah, and then our last one that we've got up here is the NASDAQ 100, which is more weighted towards tech, but it's a collection of the 100 largest, most actively traded companies listed on the NASDAQ Stock Exchange. These will lean very heavily towards tech companies, Apple, and all sorts of things. And it also ends up being more volatile. So if you're looking for a more exciting investment than the S&P, I suppose the NASDAQ could be something that you're interested in. But again, usually more weighted towards tech.
The Dow, when I started business, was at 803, gone 50 times. So in the short term, sure, it spreads out when it falls, but in the long term.
Yeah.
Stock exchanges are
Let's see there. Well, there's a few because you'll have the major stock exchanges, which you'll have the New York Stock Exchange and the NASDAQ exchange. Then you'll also have smaller ones and exchanges that trade things like derivatives, like the Chicago Board of Trade. And there's a few, I don't remember all of them, but you remember any others?
I didn't have
Yeah.
But are they all like American or do they have international?
There are also international, so you'll have, there's a stock exchange in London and there's one in Tokyo. So you have ones that represent different sectors of the world as well.
Or something, trade currency, what's that called?
Foreign exchange?
Foreign X or something like that?
Forex, yeah, foreign exchange.
Oh, yeah.
Yeah. So we'll have a couple additional ones that we look at sometimes. The New York Stock Exchange Composite is one that we like to look at a lot because it measures the performance of all the common stocks listed on the New York Stock Exchange. So this includes things like American depository receipts, real estate investment trusts, and stocks. So this gives us a really good measure of the entirety of what's on the New York Stock Exchange. So we like using that as a comparison for a lot of our portfolios. And then we've got the Russell 2000, which measures the performance of the 2,000 smaller companies that are included in the Russell 3000 index. You've got a lot of different indexes like this, but Russell 2000 is usually used as your small cap sort of barometer to see how things are moving. And you'll notice that that'll be a much more volatile index than things like the S&P 500 because it's a lot of smaller companies. And like we were just mentioning, the FTSE 100, Financial Times Stock Exchange Group, that's a British organization that specializes in providing index offerings for the global financial markets. So the FTSE 100 will be some British stocks and things on the London Exchange.
Hope that if you break it down, small cap company will have a better time to get financing.
Yeah, and small caps will also just have a lot of big growth to go. So if you have a small cap company, it could one day turn into a large cap, and there will be a lot of returns to be had between that period of time. But they also have a much lower chance of ever making it there because there's a lot less large caps than there are small caps because they don't all survive. So you'll have a lot of risk associated with that. So picking individual small cap funds can be very risky, but that's where your biggest payoffs will be. But again, you got to get really lucky or just really know how to pick them. And most people don't. So when it comes to fund strategies, there are a bunch of different ways that funds can be managed. One of the most popular and most well-received and best performing strategies is simply an index fund. And this will be a fund that chooses one of the indexes, like the S&P 500, like the NASDAQ 100, like the Russell 2000, and simply goes, we are going to copy that list one for one and just hold that and let it ride. And for the most part, those tend to perform the best because active managers, most commonly, they either miss the best days or they capitalize the most on the worst days. And just a lot of luck comes into play that makes them not perform. There are only a few funds that tend to outperform indices over time. And a lot of those are closed off and we can't get into them anymore. Yes.
Like my index, I don't have to deal with the variables that come in.
Yeah, pretty much.
That
So,
would be true for hedge funds, but also mutual fund managers themselves.
Yeah.
It doesn't matter if they do well enough over time. They might be okay.
yeah,
What you're pointing out here is the actively managed don't perform as well because there's a lot of buying and selling, spreads, prices to go up. So it's not a good idea to have a lot of turnover in a fund. Or if you own stocks, to be buying and selling all the time because the spreads and other costs.
But it's not
Yeah.
as good as for you, the investor, but for certain advisors, financial advisors, they can go.
No, we don't. If they charge a fee to manage the portfolio, they're unwise to use high price managed funds. Their home office might get part of the management fee, and that's why they're encouraged to use it. We don't fall for that little trick, we like the lower cost index. But there's a handful of funds that Nash picks out that are managed that do things that the index funds don't do, possibly to get through.
Yeah. Now, one thing I will mention that sort of as a justification for active management or as a justification for an advisor on an account that a lot of people don't take into consideration. Most people look at raw returns when they're comparing. So if you compare any of my portfolios to the S&P 500, I'll tell you right now, they're going to do worse. Guarantee it. Like, we're not going to perform as well as the S&P 500. But that's not what I'm focused on. I'm not focused on raw returns and doing the absolute best numbers year over year. What's really important for actively managed and for having an advisor is what's called a risk-adjusted return. I want to get the best level of return for the level of risk that's appropriate for you. So I might be getting less than the S&P 500, but I also might be having a lot lower volatility. So you might have a less risk of your assets declining in value over time, but you're still getting maybe 50%, 60, 70% of that return while taking on less than 50, 60, 70% of the risk. So that's sort of where those actively managed funds can come into play. And that's why I will ever choose them. It's because I'm looking over long periods of time to see, based on the amount of risk that they've taken, how much of that stock market return are we getting? So if we have much lower volatility, but we're getting kind of close, I'm going to pick that if my risk tolerance is lower than an S&P fund. Basically, yes.
So I'm thinking the smaller investor would prefer the risk-adjusted return because they want to maintain their principal.
Right. Yeah. So
They have a lot of bucks and take higher risk because they have more money to risk.
possibly.
I mean,
Yeah.
they're not going to risk all of it.
Right.
Proportionally. So I was wondering, do you have a breakdown of what percentage of people are kind of say 500 million in the stock market, say 5%, and 10% are maybe 15 million, and then go down to the smallest investor, that's 20,000 or 50,000. It would break down.
So I don't have that data on hand.
Pardon?
I don't have that information on hand. No. Yeah.
And the richer
Yeah, I might be
people
able
are
to.
gonna tell.
Yeah. Yeah. Exactly.
Yeah, and you can't go, it's an individualized process because you might have a person that's very wealthy that's freaked out about the market on a daily basis. They were on the street when they were kids, or in other circumstances, lady at the other day, everything was taken away. So she's freaked out about investing. Some can handle the risk, so you gotta follow his procedure, but then he brings into the emotional side. But I just gave Nash permission to convert a very large retirement portfolio for me to his model portfolio because he ran the things like the standard deviation, the beta, performance, expense, and his numbers slightly outperformed and were better than mine. So I understand those numbers, so he took everything into consideration, so I couldn't argue, okay, flip the portfolio to all the funds you want because yours have a history and mostly the risk tolerance and the performance, because the performance comes and goes. You could buy NVIDIA, last year and be up 700%. You buy it now, who knows? Right, so you gotta be careful.
So
Yeah.
Just a question, curiosity, what were the differences in your return numbers and his return numbers?
I don't know.
I think it was maybe 0.75% or something like that.
Yeah.
But I was also taking on less risk. So his portfolio was a little bit more volatile in times. So in down markets, he might have been down further than mine was. And then I think my portfolio returned a little bit less, but it was proportionally more for the level of risk that we were taking. So that's kind of like the conversation that I'm trying to have here and that I want to make clear is that what's most important is the level of risk that you can take. So if we know what that is, we just want to make sure we're taking that on period and that we're getting a decent amount of return for that. And then all of the little bits of active management and overweighting here and there is really just trying to make sure that without increasing the volatility, maybe we can eke out a little bit extra return. Now, if we don't, it's not too much of a problem because we stay within the channel that we want to keep you in. But really, it's just working to see while we stay in that risk level, how much can we work this? Can we get anything out of that? Yeah.
And I have to pay.
Hey, you get a big discount, okay? Don't forget the family discounts. Yeah.
Friends who are best in QQQ and QQQ. Based on what your definition here. Why would that, what's the difference between doing S&P 500 versus them QQQ as a?
Right. So, well, I mean, the difference will just be what the indices have in them. So the NASDAQ and the QQQ will be for the NASDAQ, and then S&P will be like your SPY. But if
Because it's a lower cost.
possibly there could be some. So I don't remember what SPY costs right now, but I remember there was a while ago where I was looking at it and it cost like 20 basis points, which is 0.1%, 0.20. And I was really kind of confused. And then I found another fund from the exact same company, by the way, SPLG, and it was like maybe 5 basis points or 7 basis points. So you just were losing money to fees for no reason. And you could just buy the same thing over here.
Why that's popularity.
Yeah, I think that was because one of the first ones.
The S&P is about 30% of the S&P is about. The other category is more tech stocks.
Yeah, NASDAQ.
NASDAQ, mostly tech.
Yeah.
So 100% tech. So if you do the S&P, you're only 30% tech, and that's only 7 stocks.
Oh my God.
How much stocks are in the NASDAQ?
100. Well, in the NASDAQ 100 index, there's 100.
If you want to buy tech stocks, don't buy the S&P, you're only getting 7 stocks. Go to the NASDAQ and get 100. But we warn people, don't be buying the S&P 500 unless you're aware that that's 7 big stocks make up 30%. So we're reducing some of those growth funds now. If NVIDIA fall a lot and its customers are Microsoft, Apple, and everybody else, so you could have a pretty bad day. So just be aware of that. With the NASDAQ, if you were totally into tech stock, that would be a better, more diversified.
But the difference between those indexes are just over cost.
Yeah.
So obviously for your index funds, we've got a couple examples up here. SPY will track the S&P, but there are some other ones that are cheaper than that. Vanguard has their own, SPDR has their own. There's a lot of different versions that follow the same indices.
One that's only 0.015.
Yes. Yeah, well, we're using that, but now that we're focused on ETFs, what we're using is Vanguard's version. So it's basically the same cost, but Vanguard S&P fund, because it performs very similarly to the total market, you could kind of pick a total market or an S&P, it's going to do basically the same thing. I would just pick whatever costs less. And if it's in a non-qualified account, pick an ETF. If it's in a qualified account, doesn't matter either way. But if you want that cheapest total market fund, FSKAX is the move because it's only 1.5 basis points. So a basis point is 1% of 1%. So it's almost no cost at all. So if you want just a really easy stock investment, as long as it fits within your risk tolerance and you're investing the proper allocations, FSKAX is a good pick for just really cheap, whatever. Passively managed, very similar to index funds, but usually they'll have some other qualifications for how they're choosing their investments. So instead of just picking a list and following that list and just blindly following that, they might have different factors that they want to choose funds with. So you might have a large cap factor fund that says we're going to look at the S&P 500, but we're going to place our own constraints on how we're choosing from that list. So we might say, I don't want to choose this industry. So X tech, I'm not going to choose the tech companies. I'm going to choose everything else. Or I want value. So I want price earnings ratio or whatever other parameters that they determine. They might have different factors for how they're choosing stocks out of that index. But usually those passively managed, they'll be rule-based and they'll maintain their initial allocations with very small variances, only if something totally changes and is now outside of what they want to choose. Actively managed will be really just whatever strategy they're following. The managers will actively buy and sell securities within that to attempt to capitalize on opportunities that align with the fund's stated objective. So as long as they're following generally what they've said they're going to do, they can make a lot of discretionary choices and move in and out of things actively. For the most part, they don't tend to perform as well as any index for the same level of risk, but some do. And I usually find that funds that are mostly passively managed with a little bit of active massaging are usually the ones that do the best risk adjusted. When it's full on active, there will be periods that they do much better than everybody else. But then you look long term and those returns start to kind of fall away based on the level of risk. So it really you almost have to actively manage your active managers to make sure they're in the right periods of economy so that their strategy is going to work. Because they're going to follow their strategy, but it might not be the right one for the current times. So that's why we don't really use active managed funds a lot, except for things like bond funds sometimes will allow some active bond managers to come in, because that's a market you can work it a little bit more than stocks, because it's a little, I don't want to say predictable, but it's a lot less just completely, stocks can be very random, like incredibly random. So there is some more work that you can do with bond funds, and sometimes we allow our active managers to do that.
Evaluate index funds, what market indicators are you looking at?
Well, to be honest with you, the only thing I care about when I'm using index funds is levels of risk. All I really care about is standard deviation and just making sure that that fits. We don't ever try to time anything, and we're not moving in and out of our index funds. Usually what'll happen is if I'm creating a portfolio that I want to be, let's say a growth portfolio, for example, I just want to choose an index and I'm going to buy it and I'm going to leave it there. And as long as it fills 50% or 40% of the portfolio as I've determined, I'm not really going to touch anything at that point. I'm just going to let it continue to do what it's going to do. And I want to continue to hold it for the long period of time so that I get the advantage of those average returns over time. So indicators are not really something that we're using for index funds, but we might look at just different economic factors when we're looking at something more specific, like a sector fund, for example. So if we know that tech has just been on an absolute rampage, I'm a little less inclined to buy a whole bunch of tech, because if they're super overvalued, I'm going to be a little worried that that's going to slide. If in recent, I'm just concerned that that's going to start sliding in terms of returns. And I want to make sure that I'm not overweighted in something like that. But again, the most important thing that we're concerned about is risk tolerance, and how, when I put all of these assets together, what kind of risk levels and standard deviation am I looking at? We're so much more concerned about the downside than we are the upside. We want the upside to be efficient, but I'm not trying to really beat the market in any sort of way.
Which investment ETF mutual fund company has the most money in managed funds? Yeah. How did you know that? Yeah, everybody says Vanguard only has index funds. Well, they have managed funds. They're actually coming out with managed ETFs. It's what you do with them. You're doing something that I don't have the time or I can't do, then I'm happy to pay you a management fee. But you got to be worth it. We got to see the mountain chart go up or the risk chart be less, where it's worth it. If you hire a gardener, you want to see something get done. And the reason that he might hire a managed fund or a bond fund is there is no bond market, right? There's no, like the stock market, you can't look up and see what your bonds are worth individually. You've got to go find a buyer. So he's got a really good bond manager, PIMCO, Vanguard, whoever, Then if you can liquidate, they can liquidate fairly.
So exchange traded funds, we'll kind of talk about why we like exchange traded funds versus mutual funds. With ETFs, because with ETFs, you're just buying a share. It's like buying a stock. You're buying a share of that company that represents the pool of investments, versus with a mutual fund, generally what you're doing is you're contributing dollars into that pool of investments. So with an ETF, they create their pie and then they sell you a little individual piece, versus with a mutual fund, you're just basically putting your dollars in there and they're calculating how much your dollars are worth at the end of every day. With an ETF, you can buy and sell that to whoever you want, essentially. You just go back out on the open market and you can trade it back and forth with anybody, versus with the mutual fund shares, you've got to go back to that company and have them recalculate the value of your dollars and then give them back to you. So with ETFs, you're buying and selling shares from other investors or market makers, and you buy them directly through your brokerage firm like Fidelity, TD Ameritrade, Schwab, et cetera. And these brokerage firms will also buy your mutual funds for you, but with the ETFs, back and forth between individual investors and market makers. So why do we like ETFs? Well, we like them because they trade throughout the day, like stocks do. The orders can fill as soon as there's available counterparty. With mutual funds, because they're the ones calculating the value of your dollars based on the value of what's in their mutual fund, those transactions only complete by the end of the day. You can't trade in and out throughout the day with mutual funds. With ETFs, because it's like a stock and anybody else can buy them out of your hands, as soon as there's somebody ready to fulfill that order, it can fill and it's done, and now you've got your cash or you've got your stock. They're tax advantaged when compared to a mutual fund because capital gains distributions pretty much never happen because of the way, like we've talked about before, when ETFs want to change what's inside their portfolio, they trade with a market maker or an authorized participant rather than actually selling those shares on the open market. Whereas a mutual fund will actually buy and sell and generate capital gains within that. An ETF can say, I want to replace my Apple with Google, go over to their authorized participant and say, let's just exchange these. No sale happens, no tax liability, nothing happens for you. So mutual funds, like I mentioned, bought and sold from the fund company, and you can do a direct dollar amount investment. So if you want to invest exactly $10,000, you can invest exactly $10,000. But those capital gains get distributed to you, just like any pass-through company, any pass-through entity, those capital gains go right out to you and you get to pay the taxes on those. So if you have a giant non-qualified investment account with a lot of mutual funds, you might get those capital gains distributed out to you and you get to front the tax bill for that. So even if you didn't take any money out of that, good luck, that's going to show up on your tax return. So why might we like mutual funds? Maybe we're looking for something specific that no ETF has done yet. That happens because mutual funds have existed for a really long time. So there might be something that they do that the ETF just doesn't do yet. Similar ETFs might not be traded enough. So this is just a very specific thing that usually is not too much of a problem. But if we're looking at a specific strategy, something that not a lot of people are doing, the ETF might not be very popular. There might only be a few $1 million or a few tens of millions of dollars invested, which means that there's not going to be a lot of people buying and selling them throughout the day. Now, the reason why that can be a problem is because the buyers will not, like the spread between what the buyers are willing to pay and the sellers are willing to accept will widen because there's fewer people participating. The more people you have participating in transactions, the tighter that gets and the more people are willing to accept similar prices. But when you have less people participating in those transactions, the spread will widen. And so that could be a problem when you're trading ETFs. That's a problem we've run into in our office before, is if we say this person wants to buy $100,000 of this ETF, but we see there's only a couple tens of thousands of dollars of that traded every day, we can't even fulfill their order without literally affecting the market of that ETF. We could drive the share price down or drive it up by buying so much of it. And so we would literally be affecting that market because the ETF trades by itself. Now, if we were to choose a mutual fund, we could say, put $100,000 in there, and the mutual fund company accepts our money, tells us how much it's worth, and then that's the end of it. There's no worry about spreads. So for tax-deferred accounts, these are great because you don't have to worry about the capital gains distributions at all. So when you're thinking about a qualified account, Doesn't matter whether you pick a mutual fund or ETF, just pick what does the best for you. So, couple comparisons. Mutual funds are traded on what's called the primary market, which basically means you're buying and selling from the person who created it, versus the ETFs are on the secondary market, which means something like the New York Stock Exchange or the NASDAQ Stock Exchange is where you'll be trading them with other investors. Mutual funds have capital gains distributions versus ETFs pretty much never do. It's possible, but they just don't do it because they do the like kind exchange with the authorized participants. No intraday trading with mutual funds because it calculates the value once per day at the end of the trading day, versus with ETFs, you can trade them back and forth. What that also means is it's possible that you can buy an ETF at a slightly higher value than what's inside, or a little bit of a discount, depending on how popular that ETF is and how much people want to own it. So there can be slight premiums and discounts to the net asset value inside of the ETF. Mutual funds can be direct dollar amount holdings versus ETFs are always whole shares. Mutual funds, there's no concern of volume or availability because, again, you're not buying and selling between other investors, versus with ETFs, there is a possibility of high spread or low volume. And with that, we've gotten to our time today. We have some extra slides that we'll go over at the beginning of the next class. But if you've got any questions, feel free to stick around and ask. And I thank you all for attending again.